queria agradecer ao Heitor por ter aceito o nosso convite. Esses serão seminários mensais. Então, esse mês a gente tem o Heitor, mês que vem a gente tem o Rodrigo Verde e em outubro a gente tem o Andrei Gonçalves, de North Carolina. Bom, o Heitor dispensa a apresentação, mas o Heitor nos apresentou tudo sobre restrições financeiras e investimento de longo prazo, e agora ele está nessa nova empreitada aí para desvendar restrições financeiras e capital de giro, né, e problemas de capital de giro. Então, Heitor, a palavra é sua. Muito obrigado novamente.
Okay, thank you for the invitation. Present in English is much easier for me. So if I had to present in Portuguese, I would need to practice before. So thank you. The paper is co-authored with Daniel Carvalho. I'm sure you know him, another Brazilian here in academia, and Tae-Hyun Kim was my PhD student here in Illinois. She's back in South Korea now at Chungang University. So that's the team for this paper, and the introduction is perfect. That's exactly what we're doing. We are going to right? So we're going to try to see if we can identify a credit multiplier on working capital, right? So this one of the most important ideas in macrofinance is this idea that financing frictions amplify and propagate the effect of economic shock. But most of the literature focuses on long-term investment, as Ricardo was saying. So I've done some research on that. There are some other citations here. So the idea is to look at whether, for example, in episodes of financial crisis, companies that are more financially constrained reduce long-term investment by more. The literature has also looked at employment. For example, there is some evidence that highly levered firms reduced investment, long-term investment and employment by more in the aftermath of the financial crisis. So focus on long-term, and here exactly what we're trying to do is to see if we can identify funding frictions in the financing of working capital, so short-term investment. In principle, funding frictions can also matter, right? The question is, how do we measure that? How do we identify that? This point has been picked up by the macrofinance literature, more on the theoretical side. So there are some papers that we cite in our paper that argue that when you calibrate macrofinance models, adding like a working capital constraint helps, because when there is constraints on the financing of working capital, then the financing shocks are going to have more immediate effects on production capacity. So there is this indirect evidence suggesting that constraints on working capital could also matter for the credit multiplier, but there is no empirical evidence really that we know of that really that really identifies, that measures this channel. And it's an interesting question because in principle you would think that working capital is easier to finance, right? So if you compare the financing of long-term investment, let's take like research and development, right? R&D expenses, that would be kind of the most extreme. The cash flows are long-term, uncertain, right? So it's more likely that it's going to be difficult for companies to pledge enough income to finance working capital. They might be constrained, but short-term investments like inventory, right? I mean, they should be more pledgeable. They should be easier to finance. So it's an interesting question on the empirics. We think there is evidence for a working capital credit multiplier, and how we can identify that. And that's exactly what we are trying to do in this paper. Okay, so let me start by just telling you what we mean by this idea of a working capital multiplier. So so if let's say that a firm faces a binding working capital constraint, so the company wants, for example, to purchase more inventory, or to maybe give more time for customers to pay increase receivables, etc., but it's constrained on its financing, so it can't buy inventory, for example, right? So that's what we mean by a binding working capital constraint. And so in this case, and it's also reasonable to assume that inventory, for example, is going to generate some borrowing capacity. So this is this parameter B here in the slide. So each dollar of inventory, for example, is going to increase borrowing capacity by this number B, right? B that is less than 1. Okay. So if there is a shock of $1 that causes a cut in working capital, right? So doing very simple algebra here, right? So the total change in working capital is going to be more than $1, right? Because the initial change, so if the company has to reduce working capital by $1 because you're financially constrained, but the reduction in working capital causes borrowing capacity to decrease, and it amplifies the effect of the shock. So this is an idea that has been explored in other contexts as well, and we're kind of trying to see if we can identify this amplification effect on the financing on working capital investment. Okay, so that's what we mean by a working capital multiplier, is this amplification effect. But measuring this effect in the data, identifying this is very challenging. So in particular, there's not only the usual challenge in the financing constraints literature is to clean up the empirical strategy from like general economic shock, right? So if there is a shock that change for example, a shock to profitability. So if the company is less profitable, right? If the company is constrained, then this is going to matter through the financing constraint channel, right? So there are changes that are due to financing constraint, but then there are changes that are due to other channels. So economic shocks can change working capital even in the absence of financing friction, right? So that is the usual problem that plagues the literature on financing constraints, and that's what people try to clean up, right? But then in our context, there is a second problem, which is that even if you clean up your strategy from economic shocks, okay, from these other channels, the constraint, the changes in working capital could be due to long-term investing. Okay, so for example, if there is a pure financial shock that causes the company to reduce long-term investment, so the company is scaling down because of financing constraint. Okay, so assume we clean up from the other channels, even if this is because of financing constraint, because working capital and and firm size, right, are jointly determined, then working capital could be changing because of long-term investment and not purely because of a working capital constraint. Okay, so measuring changes in working capital is not sufficient because of these two reasons. We have to find a way to clean up, to really clean up the empirical strategy and identify this working capital multiplier. And we have to find an empirical. So what we try to do in this paper is to develop an empirical approach that can isolate the amplification of shocks that are driven by the working capital multiplier. And we're not going to try to isolate the pure financial shocks, because even if we can do that, it wouldn't be sufficient because of this co-determination of short-term and long-term investment. Okay, so what we're going to try to do is to develop an empirical approach that can isolate the amplification of shocks that is driven by this working capital constraint, the working capital credit multiplier. Okay, so we have a theoretical framework in the paper that is quite general. It's not the theory is in the appendix. So it's I mean, the paper is already very long, and we have to move the theory to the appendix. We have a numerical example in the paper of our ideas, and but we do have some theory if you're interested in having a look. The way that we built this model is we have a model that is general, and it builds on a set of empirical facts that that I'm going to show you. We document a set of, I think, 5 different empirical facts about working capital that motivate our framework and that allow us to identify this working capital multiplier. Okay, and then we present empirical evidence that this multiplier is there, that it matters, and that binding working capital constraints do seem to matter, even in the sample that we have. It's a sample of small public firms in the US. Okay, so this is essentially what we're trying to do in the paper. So I'm going to start by showing you these these facts that motivate our empirical strategy, and then I'm going to use these facts to kind of explain to you what we are doing and how we are identifying this channel. And we think that this is actually a new identification strategy in corporate finance. So we're quite excited that this is something, it's a new, we think there is a new way of measuring financial constraint that seems to work well for this purpose, specifically for working capital. And maybe people can use it in other contexts. But to really explain this, I have to start with these empirical facts and then kind of develop our ideas from there. Okay, so the data is CompuStat. So this is a CompuStat paper. It's very hard to write CompuStat paper these days because people have done everything. So I'm actually very happy that we have a CompuStat paper. So standard filters. One thing I want to mention is we're going to exclude large firms. So like I said, the focus on the main results is on smaller public firms. So these are more likely to be financially constrained anyway. And in particular, in the case of working capital, there is some evidence in the working capital literature suggesting that payables, for example, have other roles for large firms. Like you have that Walmart, for example, has payables, uses payables as a quality control, for example, rather than a financing device. Okay, and then there's some other filters as well. It's a standard, but it's basically a standard CompuStat sample. Think of it, but this is focusing on smaller companies. Okay, so let me show you these empirical facts. Not surprisingly, investments in working capital are important. So what I mean by working capital, by the way, I should have added a bullet point here. Working capital is inventory plus receivable. Okay, it's the working capital investment.
Yeah. Why did you exclude firms with the positive oil beta?
Oh yeah, this is because of our identification strategy. I'm going to explain later. We are going to use shocks to oil prices as our economic shock, and then we're going to focus on firms that use oil as input. So for some firms, oil could be affecting so the firms that have negative oil beta are more likely to use oil as an input. So essentially, when oil price goes up, the company's profits decrease. So that's why we have this filter, but I haven't gotten there yet. So it's you're going to understand later, I'm sure, why we do that. Okay. So the first fact is just that inventory and receivables are important. I don't think this is going to surprise anybody. It's 1/3 of total assets, similar to PPE. Okay. And then this other fact here is more interesting. So it turns out to be the case that firms make last-minute investments in working capital, so right before they complete sales. So in principle, you could think that companies could build up inventory, like even years, right? If years before a certain quarter, but it turns out if you look at the data, the way we do this is we correlate changes in working capital with sales. So you see that working capital is highly correlated with the contemporaneous correlation is very high. So this is the parameter here in column 1. The correlation with working capital 1 quarter before is also high, but then if you go 2 quarters before, there is already no correlation. Okay, so investments in working capital seem to be made in the last minute, right before companies complete sales. So that's the fact number 1. And then the other fact that we use to develop our empirical strategy is that supplier financing is a very important source of last-minute funding for working capital investments. So when firms have to finance these last-minute investments in working capital, they seem to rely a lot on suppliers, payables. These are basically payables. Okay, so firms are using payables that are raised in the last minute to finance, investments in working capital, and they're less likely to use short-term debt. So, for example, credit lines, right? So you could think of credit lines as an alternative source. So credit lines is a less important source of last-minute funding of working capital. So the way we show this in the paper is by correlating. Now we have we're calculating. I mean, by the way, there's no identification. We're just establishing some empirical facts for now. Okay, so if you correlate working capital changes in quarter two with accounts payable, you can see that the correlation is very high, right? So companies are directing 0.7. I mean, for each dollar of accounts payable that they raise, they direct 0.6 to 0.7 to working capital investment. But if we do the same thing for short-term debt, the correlation is much smaller. So it's less than 10% of the amount of short-term debt that is raised in the same quarter that goes to working capital. Okay, so companies could be using short-term debt to finance working capital, but maybe they are doing this with some anticipation. So they could be using short-term debt that is raised like a year ago, for example, in order to finance working capital, but it's not last minute. Okay, and because of this, so this is kind of a starting point for our motivation. So there's these last-minute investments, right, that firms have to make to complete production, right? So inventory, right? These are basic investments that companies need to make. They are funded with last-minute funding that comes from payables. So what this means is that the company's borrowing capacity, right? So remember that parameter B that I talked about. So how much financing can you raise for a unit for a unit of working capital investment? This borrowing capacity is going to be shaped by short-term operating conditions. So in particular, what we argue is that seasonality is actually going to matter for the amplification effect. So if a firm's profitability is higher, and this is seasonality, it's not a profitability shock, it's predictable, right, variation in profits. If a firm's profitability is predicted to be higher, let's say in quarter two, okay, then firms should be able to borrow more from suppliers during quarter two. So you can borrow more during this period when you're more profitable because essentially you're raising short-term funds. Okay, I mean, you're raising, not short-term, you're raising financing the last minute in the same quarter that you're financing working capital. Okay,
Heitor,
yes,
I'm sorry. This isn't that the case that this has to do with short-term, active short-term capital budgeting? I mean, there is this matching principle that yes, so they match the permanent working capital with long-term debt, and this is the transitory working capital.
Yeah, I mean, it could be the explanation. I mean, for our strategy, it is important that companies are raising this last-minute funding. We don't have, I mean, our paper doesn't really explain why this happens. In fact, we're going to, one of the implications of our results is that this is actually a source of financial fragility, if you want, right? So this is going to expose companies to shocks that affect production capacity. So we are thinking about, our next project is actually trying to study I mean, why are firms relying so much on last-minute finance to fund investments in working capital, if that exposes them to this credit multiplier effect. But yeah, we don't have an explanation for why you're focusing on last-minute funding. I mean, we do have an explanation for why. I mean, not us, right? The literature on working capital does explain why financially constrained firms rely on suppliers, right? Because this is a source of financing that is suppliers have additional information, both suppliers and customers, right? So Working capital financing is one of the last resort, right? So when a company cannot raise funding from anywhere, this supplier can be a good source of finance, right? So we have an explanation for that, but the fact that this is last minute, right, is a little more surprising. But yeah.
Just as a joke, I mean, they went to a corporate finance course and they learned about the matching principle. So they
could be, yeah, it could be. Yeah, I mean, the question is, why are they not hedging? But well, we can talk about that later when I show you the results. But yeah, we're just establishing this as a kind of a motivation for our strategy, and then that kind of points out to seasonality. So we're actually going to use seasonality to identify this working capital channel, and a measure of seasonality that we use comes from a very interesting asset pricing paper by Hartzmark, Salomon, and Soltz. This paper shows that essentially companies have main quarters, that it's very predictable and it's stable over time. So it's almost like a firm fixed effect. So companies have specific quarters in which they are most profitable. And there is a way of measuring it. We're basically following the asset pricing paper. So for each calendar year, you take data from the previous 5 years, right? So that's 20 quarters. You rank the quarters and then you compute the average rank. So the paper is arguing, the asset pricing paper is arguing that this is gets rid of outliers, etc. So the main quarter, right? There's going to be this idea of main quarter is very important for our paper. It's the lowest average rank. So that's the quarter in which companies are most profitable. And it turns out that the distribution of main quarters is actually quite uniform. So if you look at the asset pricing paper or our paper, this is actually a surprising fact. I would expect companies to be Q4, right? Q4 would be very prevalent, but it turns out that the distribution is almost uniform across quarters. So there is Q1, Q2, Q3, and Q4 firm, which is a characteristic we're going to use in our identification strategy. Okay. And this seasonality has very has predictive power for profitability. Okay, so it's not just a small effect. So companies are significantly more profitable in their main quarter. This is what this table is showing. Okay, so this means that we can identify, we can measure which the quarter in which companies are most profitable. That's the quarter in which they're going to have this additional borrowing capacity, right? That this credit multiplier channel is more likely to kick in. Okay. And then the natural implication is that if we have this working capital, right? I mean, if companies are in fact borrowing more in their main quarter, then we should be able to measure that, right? And we actually document that when we look at supplier finance, right? So payables have this very important seasonal component as well, but short-term debt does not. Okay, so the way we do this is we have a measure of payables leverage, right? So I mean, working capital leverage. It's that. So the measure of leverage here is essentially accounts payable, which is kind of the debt, right? Divided by short-term investments in the denominator. We do it at changes in log. So this is, you can interpret this as a percentage change. So what we find is that companies that rely heavily on their supplier for financing. So actually, I realized I didn't really explain this, but this top supplier financing firm that is in the first row here, you can think of this group as the companies that rely most on their suppliers for financing. For these firms, we document that there is significant seasonality in leverage. So when they are in their main quarter, they leverage goes up. So they are borrowing more to finance working capital when they are in their main quarter. So that's an important fact as well. And we don't find anything for short-term debt. Okay. So and then we also don't find. So we find these patterns from the last-minute funding of working capital that seems to be seasonal, but when we don't find. We also contrast this with long-term investment. Remember that one of our goals is to separate, to contrast the working capital channel with the standard long-term investment channel. So it might not be surprising, right? But we document that firms are not typically raising external funds to finance long-term investment in the last minute. So maybe this matching principle that Ricardo was talking about. So if you correlate changes in long-term investment with changes in long-term debt in the same quarter, you're not actually don't find a very high correlation. And there is no seasonality in long-term leverage either. So that seems to be a specific, the seasonality in leverage is a specific characteristic of the of payable. Okay, so we building on, like I said in the beginning, we build on these empirical facts, right, to develop our argument. And these empirical facts, what they suggest, so the way to summarize this is that there is a link between the cash flow seasonality, right, this main quarter, and the credit multiplier, and this link is uniquely important for working capital investments, right? It's not important for long-term investment because there is no seasonality in leverage. And it's only important for firms that rely heavily on supplier finance, right? It's not important for firms that don't rely on short-term debt, for example. That rely on short-term debt to finance working capital. Okay, so what we do in the paper then is we build a model that incorporates these empirical facts. Like I said, we have a numerical example that, I'm not even going to go over the entire numerical example here because I don't think we have time. And then we have the theory in the appendix. The model is kind of based on Kiyotaki and Moore, but it's a simplified version. Okay. So the way we set up the model, like I said, we're going to have co-determination of working capital, short-term and long-term investment. The working capital investment in the model is essentially paying upfront for input. So you can think of this as inventory, for example. So you have to build inventory before you sell the product. Okay. And then the seasonality is modeled as a predictable variation in profitability. So the company has a quarter in which you're more profitable. No, I mean, here's a semester, it's H and L. So there's a semester when you're more profitable, then you move to your semester in which you're less profitable, you move back to the semester that you're more profitable. So this just goes on, okay? So we have two types of borrowing, right? Maybe using this matching principle that Ricardo is talking about. So we have short-term borrowing that you can think as payables. So the short-term borrowing is backed by working capital investment, right, and is due after cash collection. And then we have the long-term borrowing that is the long-term debt. And the difference, as I've been emphasizing, is that long-term borrowing is not going to be shaped by seasonality. So the borrowing limit on long-term debt is not seasonal. Okay, so that's going to be the key difference. So as I said already, the working capital constraint is binding when the firm would like to expand working capital but cannot fund it, conditional on the other investment, and also vice versa. Okay, so the company has a binding long-term investment constraint when you're right, it's the same thing. Okay. So the long-term investment can be exposed or not to a similar constraint. There is joint determination, as I said, and what the model does, it analyzes the link between the investment changes, investment responses to shocks, and the main quarter, okay, the age period. So this is how to think about it. So essentially, what we're going to do is we're going to compare the effect of shocks that happen in the main quarter to the effect of shocks that happen in other quarters. And what our strategy is our model is going to suggest is when the economic shock happens in the main quarter, there is going to be bigger changes in working capital in percentage terms than when the shock happens outside of the main quarter. Okay, so when the shock happens to occur in period age, then there is going to be additional changes in working capital that are due to the financing constraint, to the borrowing, to the credit multiplier. Okay, so just a numerical example here to kind of try to explain this. So right, so the idea is that there is this main quarter effect that happens because you can leverage more aggressively the investment during the main quarter. There is this leverage seasonality. So payables, right? So the payables leverage goes up when you are in the main quarter. So here is how it looks in a simple example. So remember that parameter B, right? So suppose that this B is 0.6 during the main quarter. So when the shock happens in the main quarter, for each, sorry, not the shock, like just in general in the main quarter, for each dollar in working capital investment, the company can borrow 0.6. Okay, so $1 generates 0.6 in borrowing capacity, and during the main quarter. So what will happen is this multiplier, if you do the calculation we did in the beginning, the working capital multiplier is going to be 2.5 in the main quarter. So if there is a shock that reduces working capital by $1, right, then the final change in working capital is going to change by 2.5. Okay. If the shock happens outside of the main quarter, the borrowing limit is lower. This is what the empirical facts suggest. So companies borrow more aggressively during the main quarter. The way to match this to the theory is to assume that this limit is lower when the shock happens, outside of the main quarter. So then what you see is the multiplier goes to 1.7. The same shock is going to lead to a 1.7, a change of 1.7 in the multiplier. And notice that this difference, right? Of course, in the theory, it's easy to isolate, right? This difference between 1.7 and 2.5 is due to the credit constraint, right? So the reason why there is this additional amplification effect during the main quarter is because of the working capital constraint. Okay, so the theory also suggests like ways in which we can really narrow down into this working capital multiplier. So, for example, as I've been arguing, we should only observe a main quarter effect when we have seasonal leverage, right? So if leverage is not seasonal, then this parameter B doesn't change, and then we should not observe we should not observe a main quarter effect. Okay, so for example, we should not observe a main quarter effect for the response of long-term investment to shock. So we can contrast our working capital effect to effects on long-term investment. Okay, and as the empirical facts establish as well, the working capital main quarter effect is stronger for firms that rely on suppliers, right? The payables are seasonal, payables leverage is seasonal, but short-term debt is not seasonal. Okay, so that allows us to contrast across firms. There is going to be some firms that rely more heavily on payables, other firms rely less heavily on payables, rely more on short-term debt, and we should only observe the effect for firms that rely on payables. And this is getting to Walter's question, so I thought it was going to take a while to get there. We also look at different economic shocks in the model, but one of the facts that we discovered is that shocks to input prices should have especially large effects. And I'm not going to have time to show you the details of the theoretical argument here, but I think I can give you an intuition. So increases in input prices, first, they generate a greater funding squeeze, right? So if your input price increases by $1 today, you have to come up with an additional $1, right? And the effect happens immediately, okay? Whereas like changes in revenue, right, that might happen in the future, they also matter through financial constraints, but the effect is more muted. Okay, and then there is also a substitution effect. If input prices go up, right, there is a substitution away from working capital and towards there is a substitution effect away from working capital and towards long-term investment. That might require more the model to show you the details, but we do have this. That's the reason why we're focusing on companies with a negative oil beta, because we're going, as I'm going to show you later, we're going to focus on oil price shock. Okay, so we're going to use these two contrasts. We're going to measure the main quarter effect, which is the differential effect of a same industry shock on the investment of firms inside the main quarter versus outside of the main quarter, and then we're going to contrast this looking at the companies that rely on suppliers versus short-term debt, and then companies that rely on and then we're going to contrast this across investment. I'll show you how we do this in the table. We're going to contrast working capital, seasonal responses to long-term investment seasonal response. Okay, and we should not expect effects for long-term investment.
Heitor,
So, yes.
How can you disentangle the following situation? Suppose you have the shock, could be the input price. Suppose it is a negative shock, and then you look for funding in your banks, and the banks say, okay, it seems that you need more money, but we don't know the extent of the shock, of how much you will need in the future. So I will give you money right now for you to accommodate your needs, and we will wait 6 months or 3 months to see how things proceed. And then you, when you wait for this additional time, then you can say, is this the seasonality of the working capital or the banking system that desires to see if your sales in the next cycle will be?
Okay, yeah. Well, I think it could be an explanation. This is an interesting story for maybe why we don't observe. I mean, as if suppliers don't behave in the same way, right? If suppliers are willing to give you all the funding today, then this would explain why payables have this more last minute, right, nature, and maybe short-term debt funding is more spread out over time. I don't think this is an alternative story. It actually might help explain, you know, I mean, one of our building facts is the fact that, you know, there is this seasonality in payables that you don't observe in short-term debt. So, I mean, why you think this could generate an alternative explanation? I don't.
Because it could even, you can tell the story as long-term funding, but the bank will provide the additional long-term funding in stages, and it looks reasonable to match the stage with the cycles of the fund, because it will be new information.
Yeah, I have to think about that. I think that in that case, you're not going to have the seasonality. I mean, then you wouldn't observe the seasonality in leverage that I'm talking about, and it's spread out over time, right? So you wouldn't necessarily observe that there's going to be seasonality in leverage, that the changes in leverage are higher when the shock happens in the main quarter. But I have to think more about it. Thank you.
Heitor,
yes,
ideas. I was wondering how operating cycle can affect your results or drive your results, since you have firms with long and shorter operating cycle. Have you tested something about that or checked something about that?
Yeah, this is a good point. I mean, it could be a source of, I think it's an important I mean, if firms have a longer operating cycle, then they may be less subject to this channel, right? Because it's kind of this relies on this last minute, right? You're making last minute investments to increase production today, and you're funding it in the last minute. Let me see. No, we didn't. No, we didn't look at that. Yeah, that could be something to.
Because in the second moment, I think well, since we are working with working capital, then the second moment, the accrual account can play a role when the accrual account do not map the accrual conversion in cash. Then I think the accrual quality model can help you with a second story or another explanation to show something about that, because the not long term but accrual quality can play a role in this model, because cash conversion can affect I don't know, but probably can show something there.
Yeah, this is something that we can think. I mean, for sure, the operating cycle could matter. I think our facts though suggest that on average, at least, right, we do observe kind of short operating cycles, if you want. So companies are investing in working capital today to produce, right? That's kind of the almost the first fact that I showed you, that there is this strong correlation between sales and working capital contemporaneously, right, in the same quarter. On average, of course, there's some variation there, right? So your suggestion is good. Maybe we can open that up and kind of focus on firms that have more short-term cycles versus others that have more long-term.
Okay, thank you.
Yeah, great, thank you. So these are the shocks, right? That I was talking about. So we are using this oil price shock, and let me explain why we're using this. First of all, we have to use recurring shocks, right? It can't be like a financial crisis, because we have to compare the effect of shocks when they happen in the main quarter versus, right, the effect of shocks that happen outside of the main quarter. So the shocks have to happen in different times. So, oil price is a good candidate for that. Externally imposed, right? And that can be compared over time. And as I said, the theory also suggests that it's especially promising to focus on shocks that directly affect production costs, because when the shocks affect input prices, they have stronger amplification effects through this working capital channel. Okay, so that's why we focus on oil price shocks, and that's why we focus on industries that have negative exposure, right? So if an industry has positive exposure to oil prices, then it's not an input price channel, right? So our industry shock. So what we do to build this industry shock that is due to oil prices is by multiplying oil price growth with the industry oil beta. Okay, so oil exposure is the absolute value of the estimated industry oil beta. So firms that have industries that have more negative beta are going to be exposed to a larger shock for the same change in oil price growth. Okay, so that's how we measure our shock, and then we're going to use this shock together with our other variables to identify the credit, the working capital multiplier. So the outcome. So this is how our regression looks like. So we have our dependent variable, for example, changes in working capital investment is going to be the average value of the outcome between quarter T and T+1 minus the average value in the last year. Okay, so we're going to look at different outcomes, but for example, you can think of working capital investment, changes in working capital investment, and then we have some fixed effects, some controls that I'm not going to go over the detail here. The important thing is what I'm highlighting is this interaction. So it's the interaction of if the industry shock interacted with the main quarter. So we are comparing the differential effect of the industry shock in the main quarter and interacted with top supplier financing. So focusing on firms that rely on suppliers, on payables for finance. For those are the ones that are exposed, that are more exposed to this leverage seasonality. Okay, and this is what our coefficient beta 1 is measuring. Okay, it's this additional effect. So now, after I explain this, of course, usually this comes in the beginning. In this paper, we choose to present the facts first and then explain the identification strategy, right? So we require an identification assumption, right, to interpret the results as being due to the working capital multiplier. The assumption is that an alternative mechanism, right, that you can think of, economic shocks, any other economic effect, right, would not lead to main quarter effect, right? So to differential responses in the main quarter that are also differentially important for firms that strongly rely on supply and financing, right? And that are only driven by working capital investment. So we're going to use all of this contrast, right? So we have the contrast between main quarter, outside of the main quarter, and then we have the contrast of payables versus short-term debt and working capital versus long-term investment. And we only claim victory if all of these cuts are satisfied. Okay, so that's our identification strategy. So it relies on seasonality combined with the empirical facts I showed in the beginning. Okay, and this is the main result after all the preamble, right? So that is our main table, which shows that there is in fact a working capital credit multiplier. So columns 1 and 2, we look at changes in percentage changes is changes in logs. So you can interpret this as percentage changes in working capital investment, right? Inventory plus receivables, and this is our interaction term. So the industry shock times the main quarter times the top supplier financing. So what this coefficient measures is that differential effect. So the additional effect of a shock that happens in the main quarter for firms that are in the top supplier financing group. Okay, so this coefficient is 2.3, and we are just a second. So just a second here. So sorry, I had to talk to my daughter for a second. That's the problem of presenting a paper at home. So the differential effect, right, is 2.3%. So this means that working capital investment is changing by more when the shock happens in the main quarter by 2.3% more. Okay, for firms in that rely on payable. And then in this table we're also showing the changes in long-term investment, right? So you can also try to see if there is seasonality in long-term investment. And as I said, our strategy suggests that we should not observe anything for long-term investment, which is what we observe here. Okay, and then in columns 5 and 6, we look at the difference between working capital and investment. Like the difference in outcomes as an alternative way of measuring this. And we also find significance. So working capital seems to be differentially affected by this this channel, by the seasonality channel. Okay. So
sorry, can I ask a question? Yeah.
Yeah.
So can I ask a question? So yeah, within an industry, are these top supply firms that get supply from finance from suppliers, are they different? I mean, are they like within an industry, they are like larger, smaller?
No, they are. These are, if you look at the characteristics of these firms, it's consistent with the working capital literature. They tend to be firms that look like they're more financially constrained.
They're like smaller,
less profitable. Yeah. So if it was a financing constraint paper, these would kind of, I mean, like a standard financing constraint paper, you could use this variable as an alternative way to sort firms. I mean, it's highly correlated with the other proxies for financing constraints. Yeah.
Okay.
So these are companies that are more likely to be financing constrained to begin with, but that's not. I just want to make clear that's not the only reason why we're focusing on them. It's also because of the empirical facts, right? These firms are more exposed to this working capital multiplier because of the last minute funding, right? Because the payables are because of the seasonality, right? In the payables that comes from the last minute funding. Okay, that's why they are exposed to this channel. It's not just because they are constrained in general. I mean, the literature has shown that financing constraint also matters for long-term investment, for example, right? Here we're trying to really narrow down on how can we measure the effect of a funding constraint on working capital, and our strategy is that this is a way of doing it, right? Just focusing on the top supplier financing firms and focusing on the seasonality of the shock is going to be a way that we can measure it. So this under our identification assumption, this 2.3% change in the working capital investment is due to financing. Okay.
Okay.
That's how to interpret it, and it's a economically significant effect as well. And yeah, as I was saying, I think I was talking about this when my daughter stomped in. We are normalizing the shocks. This industry shock is normalized in a way that you can interpret this as the effect of a typical shock. So it's a median change in oil prices multiplied by the median oil base. Okay, so it's normalized in a way that you can interpret it directly. So just to make it clear what this 3%. Okay.
Yeah. Just one question. Can you hear me?
Yeah.
Yeah. In your Sergio speaking, in your assumption, aren't you assuming that the firm supply is fixed? I mean, those firms that rely more on payables that has this working capital depending on payables financing, would be those firms that adjust more their supply depending on the price of the inputs. So if their costs increase, they should just diminish the amount supplied, and it would drive results like that.
This is good. This is, like trying, this is an empirical paper, and people are always trying to find alternative. It's a possible alternative explanation, right? Maybe the production, the structure of the production function is different, right? And these firms, it could be an alternative explanation. But remember that, we're not only comparing top supplier to, top supplier financing to other firms, we're also looking at the main quarter effect, right? So you would also have to explain why this channel is more important when a shock happens in the main quarter, right? And right, you have to explain why it doesn't affect long-term investment. Okay, so we think that's going to make it harder. For example, I don't see why this alternative channel would matter more during the main quarter than outside of the main quarter.
But if the firm just do that strategy, one thing that I don't know is whether this kind of credit is cheaper or more expensive. This trade credit is cheaper or more expensive than this long-term credit. It would be, yeah. And the other thing is, well, if those firms just want to adjust, it's just that, well, I don't know how much I'm going to product, and I will supply more during the main quarter. So when the shock happens in that main quarter, I will adjust more. That I think that would be the main reason for this alternative channel.
Yeah. Yeah, I see. I mean, it could be. I would have to think about more. Yeah, it's not entirely clear to me why it would matter more in the main quarter than outside of the main quarter. If it just has to do with production costs, right? Production costs are not necessarily changing, right, between the main quarter versus outside of the main quarter. But yeah, I mean, I can see that. Yeah, I wrote it down here, so maybe we can think about other ways that we can separate our financing constraint story from this one. Thank you.
Great. Thank you.
Yeah, but yeah. So other than that, right? There's of course more stuff in the paper that I'm not gonna have time to talk about. This is kind of the heart of it. We also compare firms that rely on top supplier financing versus firms that rely on a lot of short-term debt, right? So maybe it has to do with the fact that companies are relying on short-term funding, and that's what's explaining everything. So we are measuring our effect benchmarked against firms that rely on top short-term debt. We find, and we continue to find effects, and then we on columns 5 and 6 we compare working capital to long-term investment for firms that rely on payables versus firms that rely on short-term debt, and we still find our results. So that's, as I said, we only claim victory if we find all of these interactions, and that seems to be what we find. So what we conclude is that we do seem to have evidence for this working capital, right? That the working capital constraint is important, and that it does affect how shocks get transmitted, right, and amplified. So there is some extensions that I'm definitely not going to have time to talk about. In the interest of time, we're almost out of time. So we look at different shocks. For example, we look at the GDP shocks other than shocks to input prices, and those seem to have muted effects as consistent with the theory. We look at other outcomes, for example, payables, right? Our story suggests that payables should be seasonal, etc. So we look at payables as well. We look at sales and production capacity instead of working capital investment. Those should go in the same direction. Then we have a bunch of placebo tests, right? Remember, I talked about large firms, right? So large firms, first of all, they are unlikely to be financially constrained to begin with. And they don't use payables for financing the same way that smaller firms do. So we do our test for large firms, we don't find anything. We also look at cash-rich firms, right? So if companies have a lot of cash, then they shouldn't be exposed to this last-minute financing channel, right? Last-minute financing constraint may be a good way to put it. So we don't find anything for cash-rich firms. So you can just look at and then there is an interesting part of the paper that we never have time to talk about in detail when we present, is when we look at longer-term responses. So we're looking not only at the effect on this quarter, but also what happens in the next quarters. And the shock does seem to have, the financing constraint implication of the shock do seem to have some time persistent. So it's not just an immediate effect on production capacity. The effect goes on over time, and it seems to be differentially important for working capital. But I'm not going to have time to go over the details. If you're interested, I think it's well explained in the paper. So there's just some tables here that I'm not going to have time to talk about these extensions and the dynamic effect. I kind of knew for 1 hour I was not going to have time to talk about it. So let me just end here with the discussion and summarizing what we find. So our key result is that some firms, right, these firms that rely on payables for financing, they do face a binding constraint on the ability to finance working capital that has immediate impact on production capacity. So like I said, we look both at working capital investment and sales as well as an outcome. So we do find that there is an immediate effect on production capacity. So this binding constraint translates into working capital credit multiplier. So this is a channel through which shocks get amplified through working capital, through short-term investment. Okay, so it's important to talk about external validity, right? So we are focusing on a specific subset of firms. So the question is this relevant, for example, for macro finance, right? So let me mention that the fraction of firms that are in the top supplier financing group is significant. So, it has a 27 to 33% of sales. And then there is other firms like private firms that could be subject to the same channel, but are not included in the sample. Okay. And then, we have all these interactions, right? So we kind of narrowing down on input price shock and then main quarter versus outside of the main quarter, and etc., right? So there are interactive effects, but the working capital multiplier can matter more broadly. For example, even if shocks start outside of the main quarter, they may also have they may also cause amplification effects because of working capital. It's just that in our strategy we can't really measure that. Okay, so just to wrap up, we think this paper is the first micro, like empirical evidence. As I said, there is a macro finance literature that has indirect evidence that this working capital constraint is important. What we think we provide here is the first empirical evidence that there is a working capital credit multiplier. We have this new identification strategy that is a bit challenging to explain, as you saw today, but I hope you kind of had a reasonable idea of what we're doing, that builds on cash flow seasonality and all the empirical facts that we explained. But I think the idea of using seasonality for identification maybe can be explored in other contexts as well. And in terms of future research, as I said, we want to see if we can get more into the details of supplier financing, right? So I think there are explanations for why firms rely on suppliers. It's less clear that why it's last minute, for example, right? And this seems to be interesting. And then try to connect the micro evidence better to the macro finance literature, which is really the first type of the first literature that kind of picked up on this working capital channel, and we kind of want to see if we can connect our paper better to that literature. Okay, thank you for your time. If you have any questions, yes, we're out of time, right? So,
yeah. Well, congratulations. Very smart identification. Smart in the sense of intelligent and elegant. Well, it's up to you. You told us that you have to pick
3:15.
your
I only
son.
have to leave at 3:15, so it's okay.
Okay, so guys, feel free to ask.
Can I ask one question, Heitor, again?
Of
Sorry,
course.
Sure.
in the numeric example, we had the difference between 0.6 and 0.4.
Yeah.
And I was just wondering in the model, what's the microfoundation for that difference of the multiplier across quarters?
Oh, it's just because of the higher profitability. So
Okay.
it's sort of a standard model with the financing constraint. The more profitable you are, right? The more cash flow you can pledge, the higher is going to be that parameter.
Okay, and this profitability is in terms of margins or total profits or
margin?
Or
you can think
margin.
Of margin.
Margin.
Yeah.
Okay.
And it's kind of a natural implication of the framework. But then, of course, I think it's important to point out that the empirical facts that I showed in the beginning are kind of the goal of those facts is to kind of document some evidence that is consistent with this change in B.
I see.
Okay?
So this quarter that's more profitable, it's the quarter when the markups are higher or something like this? No, should I think no? Or when I'm wondering about the output. I mean, the question about output price.
Okay, margin no, it could be. I see what you're saying now. Yeah. I don't think it has to be margin, actually. Sorry, I think I misspoke there. It could be just that the main quarter could just be the quarter when even if you have a constant margin, it could just be the quarter when your profits are higher.
Okay. So it's not about markups.
No, sorry. It's not necessarily about markup. So if your profits are higher, right, you can pledge more cash flows, and then this should increase that parameter. And then we have some evidence, right? The important thing is we have evidence that firms are actually levering up more in the main quarter, so they are borrowing more in the main
Okay. So this main quarter is maybe the quarter they're selling. Margins are the same, but they're selling the most. So that's how should I interpret this.
That might be a better way. Yeah, that might be a better way to think about seasonality. It's not about, like a Christmas, right? So retailers selling more on Christmas.
Okay, it's about sales. Okay.
Yeah.
Anyone? Okay. Thank you, Heitor. Thank you so much. And
thank you. I can't hear you. You dropped down.
Okay. Thank you, guys. Next month, as I said, we have Rodrigo Verde from MIT, and in the following month, we have Andrei Gonçalves from North Carolina. I hope to see you all here again. Okay, thank you so much.
Thank you again. Thank you.
Heitor.